Welcome to KyleDavisFinancial.com, real-world money education. Who's ready for a little unfair advantage? Boy, I sure am. What you're about to see is so unbelievably special, I made a completely separate area of the website for it. Let me introduce to you the infinite banking concept. This strategy involves using whole life insurance as your personal bank and not for a death payout. There still is a death payout, but that's not the primary function of these insurance policies. So, 1, what's up with that? 2, why should you care? And 3, insurance is really boring and financial gurus say that whole life sucks. I wholeheartedly disagree. And you might too. Check this out. When you're putting money into this infinite banking style insurance policy, it's growing equity in the form of what's called cash values, similar to how home equity behaves. Now, the more it's paid up, the more you can access. Here's where it gets interesting. The cash values inside the insurance policy can earn a rate of return and grow as time goes by. Plus, there are even guaranteed minimums that are spelled out in the contracts. And once you've built up some cash values, you're able to borrow against that equity that's built up inside the policy in the form of a policy loan for whatever purpose you desire. Even if you're using the cash value equity, it does not stop the compounding that's going on inside the policy. Some companies will reduce the compounding factor on borrowed money, but I haven't ever encountered any that stop it completely. Like any loan though, there's an interest rate, and it's in your best interest to pay that loan back over time. Whoa! You mean I have to pay interest to get a loan on my own money? Yes, you do. Just like you would on a home equity loan. But believe it or not, you're still coming out ahead. I'll explain. Here's a simple example. As always, this is not a guarantee of results, but this is all how it works on a very basic level. If we had a new car that cost $30,000 and we had to finance it for 60 months at 6% APR, we would pay $4,799 in interest. So the total cost of that car is $34,799. If we had built up 30 grand in an insurance policy that was compounding at 6% a year and also had a 6% APR on the policy loan, we could buy that same car by taking a loan against our policy cash values. We would pay back the loan, same as the person who financed. So cost plus interest is the same $34,799. Here's why you should care. You're still compounding on the $30,000 even though you're accessing the cash. The interest on $30,000 at 6% for 60 months is $10,466. So once you subtract the interest paid from the interest earned, you end up with $5,667 new money that you did not have before. Same loan, same interest rate, same monthly payment. Of course, you do have to save money into the policy first to make this happen. But if you'd done that in a savings account and just paid cash, where would you be? Sitting there holding an empty savings account, that's where. I want you all to know that there's a lot of reading to be done on this subject and even more arguing about it over the internet, so you be the judge. I would highly recommend visiting the official Infinite Banking website and picking up a copy of the book, Becoming Your Own Banker. I'll be touching on different ways to use the concept and showing you actual case studies over time, but that book is pretty awesome, and it's not long either. Plus, for what it's worth, I'm putting a lot of my own money where my mouth is on this topic, so I speak from experience. As always, please leave your questions and comments for me. Need some one-on-one attention? Click the Schedule Now button up top to book a quick meeting with me. I'm available face-to-face, through video chat, and over the phone. Don't forget social media for all your reading and time-wasting needs. See you soon.